Hello, and thanks for joining us and taking the time to be with us for the 2Q 2023 SRP Market Insights. We're thrilled to have you with us. We're going to try to cut through the noise and some of the confusion and uncertainty and try to go through some of what's going on behind the market moves. So hopefully that you can learn as a fiduciary, or if you're learning for yourself or your personal portfolio, whatever it is, we hope that you can take something away from this today and that it's time well spent for you. My name is Dave DeTagios. I'm a managing director in our Chicago office. I'm here with Bob Wagner, our chief investment officer, fellow MD from our Florida office, Phil Senderowitz, and our CEO, Jeff Cullen. Thanks, guys, for taking the time to join me today.
Thanks,
Pleasure.
Bob, can you jump in and just look at the headwinds, tailwinds?
Yeah, not much has changed since last time. However, what did change was kind of big. I'm not going to go through all of this, all the bullet points there. Most of them were there last quarter. But what really changed this last quarter that's important is, one, we had a banking crisis. And, as we've talked about before, there's a, real difficult situation for the Fed. Well, things got a lot worse with the banking crisis. The other thing that happened was OPEC Plus got into the mix, and they've been reducing their oil production, so that's causing inflationary problems as well. And the last one is China's been getting a little bit aggressive with Taiwan, and so those are the main differences, and we're going to be covering some of those topics more in details coming up.
Bob, can you talk about this one?
Sure. Now, this is kind of where we're going. If you remember last quarter, we talked about how monetary policy and fiscal policies are at loggerheads. They're working against themselves. As you know, the Federal Reserve has been increasing rates because they're trying to slow down the economy, trying to get inflation under control. Matter of fact, next week, you can pretty much bet on a 0.25% rate hike by the Federal Reserve. The problem is, on the other side, fiscal spending has been going higher, but we also have inflation adjustments to things like Social Security. So we just had like the highest increase in Social Security in the last 40 years. So you've got more money being spent, and the Fed's trying to, which is inflationary, and the Fed's trying to calm all that down. So we have two major forces at conflict with themselves. And so that's the big challenge that we've got right now, is how all this works its way through the system. Now you take this situation where they're already at loggerheads, and then you throw in a situation with a bank crisis, and things just get quite a bit more difficult.
Jeff, you want to talk about rock in a hard place for the Fed?
Yeah. So the Federal Reserve has a dual mandate of managing inflation and tempering that, and maintaining their idea of full employment. And you see that these two things right now are at odds with each other. With inflation, it's creating an incentive for them to hike interest rates, and then and all those factors on the left-hand side are leading to inflation. The kind of big unknown that's kind of hanging out there right now for the economy is, what we're seeing right now with AI is going to have a tremendous deflationary effect on the economy, and is likely to help us with fighting inflation. But that's more of a it's more of a mid to long term solution that can help us with some of this. But in the short run, inflation is still present. As far as the incentive to cut rates, with this banking crisis and with the lending being as low as it is, that is going to catapult us towards recession even faster, which is why you're seeing the yield curve inversion. The yield curve inversion is basically signaling an upcoming recession. All of the predictions of where rates are going are signaling that we'll be looking at one sometime around the turn of the end of the year. And so where do you go?
Bob,
Yeah,
any comments?
Yeah, I was going to say, I'll just add a little bit to that. they always describe monetary policy as pushing on a string. The problem we face now is if we do go into a recession, what's the Fed going to want to do? It's going to want to lower rate to stimulate growth, right? Well, the problem is if they lower rates and banks don't lend, the restrictive bank lending kind of neutralizes any power the Fed has. So the Fed more than likely is going to be weakened going into this next recession because one of its major tools has probably been substantially weakened just by the fact that banks are going to be less likely to lend.
And further to Jeff's point, by the way, on AI really being disinflationary, it also has just probably medium to longer term big effect on employment because one of the main reasons it's going to be disinflationary is because it's going to lower costs for companies because they're going to be able to have a lot fewer workers doing the work because AI is going to take care of it. So it hits both sides of the equation.
Yeah, which is what I find to be concerning right now is this could be, we're at this point where it looks like, okay, recession's on the horizon, but geez, it's not even remotely close to 2008, right? It's going to be just kind of a mild thing. Well, depending on how big the layoffs are, as CEOs try to explore, what are the cost efficiencies available with AI? This recession could be quite a bit more nasty than people are anticipating at this point. So I think the jury is still out as to what we're really looking at here. And I think we need to, enter this coming period with a degree of respect and caution with that in mind.
As you had mentioned, Jeff, the potential for CEOs or leadership to use the recession or what's going on as an opportunity to get extra thin, right? Mm-hmm. And potentially replace it with not people, but other solutions.
Yeah, I mean, it's already happening in Silicon Valley with companies like Google, Twitter, Facebook. It's only a matter of time before it finds its way to Main Street as well.
One sec here. Wouldn't be market insights without the yield curve.
Yeah.
Jeff, any insights on this? It's looking pretty unique and crazy.
Yeah, I mean, and what you're seeing here is the difference. The light blue yield curve is from March 2nd, and the dark blue yield curve is March 23rd. What a difference a few weeks make when all of a sudden the market realizes that we might be amidst a banking crisis. And that's really what you're seeing here, that with Silicon Valley Bank and Signature Bank and some of the others that went into receivership, what the backside of the yield curve is saying is not only do we believe this banking crisis is a real issue, but on top of that we believe the Fed's going to be forced to cut rates a lot sooner than they've previously indicated.
Yep, and in impact on the banking sector or financials, Jeff, from an asset allocation standpoint, and what that means for potential value equity as well when we're looking at asset allocation.
Yeah, and I think it's a good learning experience to just bring up, like, if you're a bank, you have the liability, right, which is the money that you've put into the bank. They owe you that money back. And then you take that liability and you invest it into assets. But the assets that you're investing it in, whether it be treasuries, whether it be mortgages, whether it be auto loans, student loans, whatever that debt might be, is of a much, much longer duration, and therefore much more sensitive to interest rates than the deposits that are your liabilities. So when the Fed has increased rates as much as it has, the value of the assets on your balance sheet has decreased significantly. That's what's causing the banking crisis. It's not that the assets have not necessarily been impaired yet, but their market value, if they were forced to sell and there was a run on the bank, is far less than what they are showing on their balance sheet as the book value that they're carrying it at. And so that's why we're seeing this insolvency issue. So if rates do go down, the good news is the value of those assets are going to go back up. So it does help to get the banking sector a little healthier faster.
Another factor, when you look at it, if you have the short end of the curve and the long end of the curve, the short end of the curve, as rates go up, people are very happy to move their assets to wherever they can get higher interest rates. on the longer end of the curve, if interest rates go up, you say, I'm going to keep paying my lower interest rate loan. So you have to pay more. A bank has to pay more on the short term and doesn't get any more money on the longer term loans. They are assets.
Phil,
Right,
what are we
which
seeing
is-
here on the right side,
Yeah.
Phil, like with the banks?
And with that, the shock that happened during March, you can see all the way on the right-hand side, smaller banks are just inherently at a disadvantage to bigger banks. That red line going down on the right-hand side is all the money leaving small banks. And if you look over on the large bank side, all the money going to the large banks. And that works against what the Fed was doing, because that money wasn't moving from a small bank to a big bank because the yield was higher, or they were getting a better return. It was just the perceived safety of the bigger bank. And actually, the bigger banks tend to pay less on those short-term deposits. So you have the Fed trying to raise rates, and money's actually flowing to a lower yield security. Kind of counterintuitive.
And Bob, we could talk about this for hours, which, people would start throwing things at the screen. But just in the last couple of minutes with a couple charts, did you want to talk about this treasury yield? And if you want to geek out with us, we'll do it at any time. So just reach out to your SRP representative and we'll schedule more time. But did you want to talk about this, or do you want me to look at the next page?
I'll just make a real quick comment here. What's really interesting about this is, one, you'll probably never see a yield curve like this again. But if you take a look at the very short end, which is the far left side, see what it says 4.08? What's happened is all the money from the regional banks went to the money center banks, and the money center banks just simply poured it into the market, driving interest rates lower. Now, remember where the Fed funds target is, and it's expected to go higher. Next week, it's supposed to be up over 5%. The short-term rates are well below that. So the markets are well below what the Fed is charging, right? But then you also see the ballooning out there. That dark blue is where it was the previous peak of the yield curve that we covered on the other one. Look how it's gone higher during that period. Now, why in the world would that rate have gone higher? Well, the problem is that's the area where the debt ceiling argument's going to come. And you always, whenever you hear that time about defaulting in the government debt, what they've been doing is they've been selling that 2 to 6 year T-bill, and they're buying the overnight. And that's why you've stepped on the very short term and driven up the 3 to 5. And that's why you get that odd balloon there. And then, of course, you fall into the inversion part where the longer term is just well below the current rates. So that's a very confused market. And, there's a couple things on the horizon that need to get resolved to kind of straighten that thing out. And we're going to actually cover them in a second. So if you're asking, where are we going, or what do I need to watch for? Because this is a confusing market. Well, the dollar had a very strong year last year, and it's been relatively weak now because of the yield spreads. Well, as you can see, the dollar is resting on some key support. If rates start to go lower here, that's probably going to lower the dollar, and that could be inflationary. So that's a real complicating chart. Right. And so and also remember, commodities are priced in dollars. So a lower dollar also will make gas and global commodities more expensive as well. Same, and this is another one. You got to watch crude. You've got OPEC plus now playing in this field. If oil starts to go higher, that's going to be inflationary. That really complicates the role for the Fed, especially if they're fearing a recession. The last thing you want is higher inflation during a recession, because what is that? That's stagflation. So you put all these things together, right? And let's go on and take a look at the S&P 500. What do you get? You get a hurry up and go nowhere market. If you take a look at this chart, it's been up and down, but it's not really going anywhere. You're essentially back to the same level you were a couple years ago. Okay, but you got to get that corkscrew looking pattern. And what is that? That's the market what trying to figure out where it wants to go. Now, those two catalysts that we just showed, the value of the dollar and the oil, may be the determining factor on which way this goes, because the Fed doesn't get things under control. The inflation keeps high, and interest rates remain high, and then forward earnings continue to weaken. You can make a solid case that the equity markets are probably going to go lower from here. But if we get things resolved on the right side, this may be a good time for the market to start taking off again. But the bottom line is that's a confusing market, and I think we went over all the factors on why this is confusing. And so hopefully we gave you a couple catalysts to watch for, so you can form some better opinions on what may be coming down the road.
Yeah, thanks, Jeff, and Bob and Phil. Thanks so much for your time and insights. Thanks to everyone for joining us. And just remember, for your 401k, we're not trying to time the markets. We believe in the dollar cost averaging in and buying into the market through the ups and downs, and also just making sure that you're comfortable with the risk in your side of your portfolio. So in terms of your own portfolio, if you have any questions, feel free to reach out to your local SRP team. Thanks so much for tuning in, and we'll talk to you next time.